This is Nightly Business Report with Bill Griffith and Sue Herrera.
Hang on tight. The market tanks, then climbs its way back, and it may be because stocks no longer react to earnings and forecasts the way they once did.
Sounding the alarm, Bellwether's Caterpillar and 3M warn of rising costs and issue weaker outlooks, unnerving shareholders.
Pockets of strength, the areas of the market that are making money even amid this volatile streak. Those stories and more tonight on Nightly Business Report for Tuesday, October 23rd.
And we do bid you good evening, everybody, and welcome. So what a ride again. Investor nerves were frayed at the open this morning when the Dow plunged more than 500 points after some very big blue chip companies reported quarterly results. For the most part, the earnings were good. It was what CEOs had to say about the future that the market didn't like, and some important levels were tested during the day. The Dow traded below 25,000 for part of the session. The S&P 500 cracked 2,700 for a time, and that was for the first time since July. And the Nasdaq flirted with correction territory. But then a rebound. It wasn't sharp, but slow and gradual, and the Dow actually came within a few points of breaking even. And when the closing bell rang this afternoon, the Dow was down 125 points to 25,191. The Nasdaq fell by 31. The S&P 500 slipped by 15. Now, this latest bout of selling and volatility comes during the busiest week of earnings season. And as Bob Pisani reports, so far there has been a different response to the results this time around.
Earnings season is in full swing, but right now the market has got a problem. Many stocks are no longer rising on good earnings or even good guidance. The market typically rewards companies that raise guidance and punish those that don't. But something different's happening this quarter. Companies that have raised fourth quarter forecasts or analysts who have raised the forecasts on their own are not being rewarded with higher prices. Take CSX, United Rentals, Citigroup, VF Corp, all of them posted earnings beats. They saw fourth quarter estimates raised by analysts, but they're all trading down since their reports. What's going on? The market's trying to figure out if the positives outweigh the negatives right now. And some are worried that the positive momentum from the tax cuts are waning a bit. Remember what the stock market's been rising on all throughout the year. Strong economy, higher revenues, tax cuts, and partially reduced regulations. But new headwinds have emerged in the last several months. Tariffs, higher rates, higher commodity costs, and now we've got some country-specific issues that are weighing. Concerns over China slowing, Italian politics, and Saudi Arabia, which is important since Saudi Arabia is a major investor in technology funds. Goldman Sachs noted that 56% of companies who have beaten earnings expectations as of Friday's close have underperformed the S&P. Normally, we'd see outperformance of better than 1%. Not happening. So far, companies that have missed on earnings have underperformed the S&P by 3%, and that's worse than the historic average. So what do we make of the market when those that do well underperform the market and those that don't do well, they sell off even more? It's hard to decide, but maybe not much yet. But the fact that stocks are not rising on positive earnings is certainly worth keeping an eye on. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The early rout started when Caterpillar and 3M reported results. Industrial companies were already in focus given their international reach and exposure to China. The disappointing comments raised fears of slowing economic growth, and that sent shares of both Caterpillar and 3M lower. Morgan Brennan has the details.
3M's disappointing results rippled through the industrial sector. The company reported slowing sales across the board, especially in healthcare and consumer segments, for which sliding consumer product sales in China was mentioned on the call. Currency is a headwind, so are rising costs. The reason the maker of Post-it notes and industrial coatings now expects a roughly $100 million headwind from tariffs. Still, 3M does expect to offset those costs.
Our view is we have approximately a $100 million headwind from tariffs, and that our pricing will more than offset that and raw material price increases into 2019.
That's really the theme for industrials so far this earnings season. Higher costs versus higher pricing, and what that means for margins. Take Caterpillar, which did beat and also reaffirmed its outlook. The stock still tumbled in trading today. Why? It's become more expensive to manufacture those earth-moving machines it makes. But management did say cost headwinds will come in at the lower end of previous guidance, and that higher prices from tariffs are already baked in.
We've been on managed distribution. So we don't expect a major impact because, quite frankly, we were already hit with the earlier tariffs. So we don't think a later change will have an impact on us. It was already baked in for us.
CAT, like 3M, plans to raise prices on the products it sells to make up for those higher costs. Analysts say economic growth is still solid, but that investors are taking trade-related risks into further account.
CAT has really executed quite well. So they're surprised to the upside, as you mentioned, for quarter after quarter after quarter, and that's not always, easy to do. And so kudos to them for doing it. I think that tariffs have introduced some uncertainty into the market, and they're managing through that. And so as we kind of understand what that risk is, then we can sort of price that in better, and maybe the risk comes down.
It was a similar story for United Technologies today as well, as the industrial conglomerate said it too will hike prices across its portfolio as long as tariffs are in place. For Nightly Business Report, I'm Morgan Brennan at the New York Stock Exchange.
Now, investors did have a few things to cheer today, most notably McDonald's quarter. In fact, the fast food chain stock was today's best performing blue chip after the company topped expectations and reported its 13th straight quarter of same-store sales growth. And as Kate Rogers tells us now, the earnings beat comes as the company makes global business changes.
Are loving it overseas. Sales were better than expected in McDonald's international markets. Growth was bolstered by restaurant renovations designed to modernize the Golden Arches, including self-order kiosks, delivery, and even table service. While business was strong overseas thanks to those modernization efforts, it was weaker than expected in the U.S. as the competitive landscape in the fast food space remains stiff. McDonald's is also aggressively renovating its U.S. locations, updating about 1,000 restaurants per quarter, and will invest about $6 billion to modernize most of its units by 2020.
I think we're seeing the benefits of the experience of the future and the company's other velocity accelerators such as delivery and mobile order, not only in international markets, but also in the U.S. There's been some disruption as they rolled it out, but I think if you take away and look at it at a high level, I think that they are seeing benefits from that, and that's helping to offset some of the promotional activity within the category.
But those changes have come with pushback from U.S. franchisees, hundreds of whom recently met in Florida, claiming the changes, coupled with menu innovations, aren't paying off quickly enough. CEO Steve Easterbrook acknowledged on the earnings conference call that franchisees are taking on a lot at once, but reaffirmed the company's vision for change.
At our current pace, by the end of 2019, we expect to complete over 12,000 restaurants with our Experience of the Future initiative, making this the largest construction project in our history. We still have hard work ahead, but we're seeing an encouraging response from customers in restaurants where many of these improvements are already completed.
Easterbrook also said the company is looking to refocus on breakfast and will roll out more deals to help bring diners back to restaurants as the value wars continue. For Nightly Business Report, I'm Kate Rogers in New York City.
And fellow Dow component Verizon topped Wall Street's profit expectations. The telecom giant added subscribers at a quicker than expected rate as it presses ahead with its plan to offer a faster 5G network. Verizon did report a revenue decline in its wireline business and said it is struggling to meet financial targets in its Oath Media and Advertising unit. Nonetheless, the shares were up 4% to close at an 18-year high.
Well, we've invited a couple of pretty smart market watchers now to talk about why stocks have been acting the way they have during this very volatile month. Joining us tonight, Jeff Kleintop. He's Chief Global Investment Strategist at Charles Schwab, and Peter Bukvar. He's Chief Investment Officer with Bleakley Advisory Group. Good to see you both. Thank you for joining us tonight.
Thanks. Thanks.
Jeffrey, it seems like as soon as we turned the calendar over to October more than 3 weeks ago, that the market suddenly went into volatility mode. What's your version of what's going on right now?
Well, I think there's two things behind this, Bill. One is we've known about the risks of slowing revenue growth for some time. That's not new news in October. But rising costs are. We just talked about it earlier in the show. Rising costs, whether it's Caterpillar, even McDonald's. But take a look at the difference there. McDonald's was able to pass on some of that, whereas some of the others were not. So the combination of slower revenue growth, but now new discussion of rising prices, rising inflation on materials and labor. That's new and potentially a weaker outlook for profits. The second thing is the buyback story. Every time we get to this point of the earnings season in October, corporations do less. They limit the number of their corporate share buybacks. This time, however, it's joined by individual investors who have turned into net sellers in the second half of this year based on industry data. So with no buyers, institutions not buying and individual investors selling, we're seeing much more of a downdraft this earnings season.
So, Peter, you think that higher rates, the tightening central bank, makes this market more vulnerable to some of the other issues, some of which are geopolitical out there, correct?
Happens every time. The deeper you get into a tightening cycle, accidents begin to happen. Now, the accidents started overseas with you had the short VIX trade blow up, Turkey, Argentina, Italy, and it's now beginning to cause some issues, obviously, in other parts of Asia with China and in the U.S. So when the liquidity spigot starts to turn off, when rates start to go up, it starts to impact not only valuations, but starts to impact economic activity. You look at housing and autos, obviously the two most sensitive interest rate areas of the economy are already slowing down. Now, the offset up to this point has been a strong earnings story.
Right.
But now there are some holes in that in terms of profit margins. So you have the tightening of monetary policy, the rise in interest rates, with maybe a peak in profit margins, and I think that confluence of events is causing this volatility in the markets.
So that's why you think, and we saw this from the very beginning of earnings season when the banks reported blowout numbers and their stocks went down. You think that's partly what's going on here?
Yes, and you even saw it in look at Netflix, for example. A great quarter, big upside in their subscriber numbers. The stock had one good day and gave it all back. And I think that's an important thing because up to this point, it's been earnings strength that has offset the monetary drag. And now maybe we're losing some of that support.
You know, Jeff, talk to me about the recession indicators that you're looking at. I mean, the economy, to people on Main Street and elsewhere, seems to be really chugging along quite nicely. Why are you worried about a possible recession?
Yeah, there's good, and there's maybe too good. One of the things I like to watch is the difference between the unemployment rate and the inflation rate. You know, historically, those two are usually pretty far apart. The unemployment rate's much higher than the inflation rate. But when they come together and become the same number as they have about a year before each of the last 3 U.S. recessions, it tells you that the economy is overheating and likely to experience a recession in about a year. We're not there yet. It's still about 1% apart in the U.S., in Japan, in the U.K., Germany, other places. But we're getting close. I think in the next 6 to 18 months, that could cross over. And that combined with the increasing rates from the Fed suggests we might be seeing a peak in the global economic cycle sometime in 2019, and investors might be beginning to brace for that.
So what do you do? I mean, is this why, Jeff, the market has become as defensive as it has? We're seeing the so-called defensive sectors outperform this market lately. Is that what's going on?
I think it is, Bill. I think investors are beginning to position for that end of cycle. It might be a little early still, but certainly looking out again 6 to 18 months, it could be there. I think looking at your portfolio, trimming the more volatile areas like emerging markets or even like tech stocks if you're overweight there, that's certainly a volatile area to take a look at. And secondly, think about bonds here. You know, the 5-year Treasury now at 3%. That's not a bad entry point for longer-term investors to manage some of the volatility in your portfolio. No one's perfectly comfortable with losses, but if you're losing sleep over your portfolio, you may have a bit too much in stock.
Very quickly, Peter, where would you put money to work today?
Well, I think that the international markets that have sold off so much start to nibble there. The U.S. market is still very expensive. Short-term bonds are an attractive place, and I particularly like gold and silver.
Right.
Short and sweet. Always smart people that we like to talk to. Jeff Kleintop from Charles Schwab, Peter Bookvar from Bleakley Advisory Group. Thank you both for joining us tonight.
It's a pleasure.
And it is time for a look at some of today's upgrades and downgrades. Lowe's was upgraded to buy from neutral at Citi. The analyst cites Lowe's turnaround plan and the strength of its management team. The price target is $112. The stock rose just a fraction to $98.12. VF Corp was upgraded to outperform from neutral at Wedbush. The analyst does not share Wall Street's concerns over growth and margins. The price target is $94. The stock was up a fraction to $77.71.
Viacom was upgraded to inline from underperform at Imperial Capital, with the analyst citing factors including the market's rotation from growth to value in the media sector. Price target now $29. That stock fell to $32.71 today. And NXP Semiconductor was upgraded to overweight from equal weight at Barclays. The analyst cited the recent pullback in the stock and sees the company's earnings moving higher. So the price target is now $95. That stock was up more than 1.5% today to $77.72.
Still ahead, crude craters after a Saudi official makes a pledge. A Federal Reserve official favors more interest rate hikes. Atlanta Fed President Raphael Bostic offered an upbeat outlook on the economy. He says he believes the central bank should continue on its path of gradual increases, citing the risk of the economy overheating. He explained that there's little reason to keep the Fed's foot on the gas pedal.
President Trump is pushing the idea of a middle-class tax cut. He floated the idea again today during a photo opportunity in the Oval Office.
We're putting in a tax reduction of 10%, which I think will be a net neutral because we're doing other things, which I don't have to explain now, but it'll be pretty much of a net neutral. But it'll be great for the middle class. It's going to be a tax reduction of 10% for the middle class. Business will not enter into it. And this will be on top of the tax reduction that the middle class has already gotten. And we're putting in a resolution probably this week. I think you folks know about it. And Kevin Brady's been working on it very hard, really for a couple of months. We'll put that in and we'll start the work after sometime after the midterms.
Congressman Brady chairs the tax-writing House Ways and Means Committee, and he said today the measure would be crafted in the coming weeks.
President Trump will meet with China's President Xi Jinping at the G20 summit next month. According to White House economic advisor Larry Kudlow, the two will, quote, meet for a bit, but Kudlow did not provide any other details. The meeting comes at a time of escalating tensions over trade. The Trump administration recently put tariffs on $200 billion worth of Chinese imports, and Beijing immediately retaliated. The two countries remain far apart on some key trade-related issues, such as intellectual property rights and technology transfers.
The European Union today formally rejected Italy's budget, an unusual but not unexpected move that puts Brussels and Rome on a collision course. The budget proposed by the Italian government increased both Italy's overall government debt and its deficit in the short run, both violations of EU rules. An official said today the EU was given no alternative but to reject the proposal, which caused Italian bond yields to rise. Italy now has 3 weeks to make changes.
Oil prices tumbled today after Saudi Arabia pledged to increase output. Saudi's energy minister said for a second straight day that the kingdom will keep the world adequately supplied with crude. Add to that recent forecasts that global demand for oil is slowing, and you have a down day for domestic crude, which fell 4%. Recall that U.S. sanctions on Iranian oil begin on November 4th, and Washington has said it wants to stop all of Tehran's fuel exports.
Harley-Davidson faces weakening demand in its largest market, and that's where we begin tonight's Market Focus. The motorcycle maker reported its biggest decline in domestic sales in 8 years as it struggles to attract younger customers. The company had better luck with its international markets, specifically in Europe, where sales rose and helped overall. Results edged past expectations. Harley also warned that tariff-related costs would cause shipments for the year to come in at the low end of guidance. Shares were down 2% today to $37.87. Pulte Group sold more homes at higher prices this past quarter, and that helped the home builder beat earnings expectations. Revenue also rose. In addition, the company said that it expects average selling prices to continue to climb this quarter. Shares rose by 7% today to $22.40. And JetBlue reported earnings that edged past Wall Street's estimates, even as a rise in fuel costs hurt its results. The airline said that it has a plan in place to improve margins and offset higher costs, adding that fare increases will be part of that strategy. Shares were up a fraction to $16.63.
Lockheed Martin said a rise in revenue in all of its units helped overall earnings soar past estimates. The aerospace and defense contractor raised its profit outlook for the year and forecast revenue above Wall Street targets. The company also said sales could rise as much as 6% in 2019, as long as key programs continue to receive funding from the government. Lockheed shares were off more than 1.5% to $321.35. Biogen said improved sales for its multiple sclerosis treatment led to an overall earnings beat. Separately, the drug maker said its experimental lupus drug failed to meet goals in its study trial, but shares still finished up a tick to $316.15. And the known short seller Andrew Left said he now has a long position on Tesla's stock after shorting it for more than 2 years. The reason for his change of heart? Left says Tesla is destroying the competition and pulling customers away from a number of car makers, including Mercedes and Honda. Shares of Tesla popped more than 12% to $294.14. And the aluminum products maker Arconic is reportedly considering an $11 billion acquisition offer from the buyout firm Apollo Global Management. Reuters says that offer values Arconic at between $23 and $24 a share. The company hopes to make a decision on whether to sell itself before it holds its investor day next month. Arconic shares fell more than 3% to $20.65.
Coming up, we are looking for pockets of strength in this otherwise head-spinning market day.
It is no secret that October has been volatile. But even with the broader market down more than 5%, there are sectors that are higher since October 1st, namely utilities and consumer staples. So let's talk more about those pockets of strength with Mike Bailey, Director of Research at FBB Capital Partners. Nice to see you. Welcome back, Mike.
Great. Thanks for having me back.
We're going to get to some specific picks in just a minute, but I guess I shouldn't be surprised at the strength that we see in the utility sector and consumer staples, right?
Absolutely, yeah. So if you're in sort of a risk-off moment, it does seem like that's kind of where we are. Maybe you look for the most attractive areas or the safest plays, if you will. Utilities are definitely at the top there. So I think what we're seeing is investors are really worried about, for example, tariffs. What are those doing? Rising interest rates, a stronger dollar. If you sort of think about what parts of the market are sort of immune to some of those, utilities is definitely at the top of that list. So they're mostly domestic, so there's no tariff impact, there's not a lot of currency impact. There's a little bit of risk around interest rates, right, but I think investors are not too worried about that at this point.
Well, I was going to ask you about that because so many of our viewers invest for dividends, and utilities are a typical place to invest for dividends. How do they perform, though, as rates rise? They usually don't do that well.
That's right. That's right. So we're seeing a little bit of a kind of a counter argument, if you will, to that. I think part of it may be just looking at what are investors really worried about. So I think the flavor of the moment is probably tariffs and perhaps currency and sort of any company doing business outside the U.S. if there's some kind of global slowdown. So if that's the fear, then maybe utilities are sort of the perfect setup there. But you're right. In general, if we do see interest rates continue to creep up, that's going to make other investments, such as safer bonds, maybe more attractive than sort of a safer utility stock.
So let's get to some of the names. You gave us 3 names in the time we have remaining. CME Group is one that you favor at this point. Why is that?
So CME, in some ways, is sort of taking advantage of the drama. We're seeing it really this month. So the company's an exchange. As investors are trading, they basically take a small fee there as an exchange. They're sort of a toll taker. And the drama we've seen this month is a lot more trading, a lot more volatility. They participate in that, and they really benefit there. So we do think that between now and you're heading into next year, you may see concerns about, when is the recession coming? When is the equity market going to slow down? That will probably translate into a lot more trading. So CME really participates there. They're also doing an acquisition. We think there's some upside there. So we do like that one. It does also pay a fairly attractive dividend.
And just as we go here, we saw on the graphic as well, you also like Honeywell and Net Era Energy.
Thanks, Sarah.
Thanks. Thanks for joining us tonight, Mike Bailey.
Thanks for having me.
With FBB Capital Partners. And finally tonight, the country is obsessed with Mega Millions, and so are some of us, at least. The jackpot, as you know, is $1.6 billion, and people spent the day dreaming about all of that green.
I would buy a 747 jet, okay? Retired one. Have it gutted out, renovate it, and have it converted into a home.
Probably buy a couple of houses, travel the world, probably, just enjoy life.
First of all, I'd help my family and my best friends.
I think I'd buy the New Orleans Saints. I'm a big fan of the Saints, so I think I would go down there and buy that franchise.
A mansion, and I get my own room, and my sister gets my own room, and I get a PS4 and a big screen TV.
But allow me to be the voice of reason. In the end, the game comes down to simple math and very, very long odds. According to a statistician from Columbia University, to convert the odds of 302 million to 1 into something tangible, it would be like laying 3,820 miles of pennies edge to edge in a line that would extend west from New York City to Los Angeles and then another 1,000 miles into the Pacific Ocean. Or to reverse that, east to from New York City, you'd have to go past Paris, France. Obviously, the odds of winning are the equivalent of picking out the single jackpot penny from that line. Good luck.
What's wrong with that? Before we go, here's a look at the numbers on Wall Street today. The Dow was down 125 points. It was down more than 500 points midday. The Nasdaq fell 31 and the S&P 500 slipped 15. That does it for us tonight. Good luck. I'm Sue Herrera.
I'm Bill Griffith. We'll see you tomorrow.